Hello, welcome back. So, American Express is a company that I'm getting more and more interested in, and I wanted to make a video, chat a little bit about it, and basically analyze the financials, see whether it makes any sense to buy this one today. Now, I do understand that many people could have a fear about American Express, about holding American Express, because of the current inflationary environment, thinking that this will cut down consumer spending pretty much. And that is definitely a valid concern, but the other thing that you want to be thinking about is a couple of things about how American Express is benefiting from a potentially higher inflationary environments because for instance, they can and more than likely will increase their fees that they're getting per transaction, as as part of balancing themselves out, their payments out in terms of their inflationary expansion. And also, there is another thing. When inflation expands and you're getting higher prices, then American Express, for example, or Visa, get a higher cut out of the transactions that are made. And since people will still be doing quite a lot of transactions regardless of the environment, and companies of that sort may not be hurt as much as you may initially think from an inflationary environment again. In some situations, they may even gain. Now, there is another thing that kind of points to these companies actually gaining right now, at least for now, and I wanted to chat about it because higher inflation and people still spending money is good for these companies. Now, for instance, you will see that the US economy kicks off second quarter on a strong note, rise in inflation slowing. This is last days pretty much article. You will see that consumer spending increases 0.9 in April. And as consumer spending increases and we still have an inflationary environment, that's of course good for companies like MasterCard or American Express because they're making more money per transaction. And if transactions are not slowing down, you can understand that they are doing better and better. And this is why Visa, for example, their last quarter had a blowout one. So, interesting things to notice here that U.S. consumer spending rose more than expected, and households boosted purchases of goods and services as the increase in inflation slowed. That's another very interesting thing, and it is a little bit of a balancing act here because you want spending to kind of decrease a little bit so that you can decrease inflation, but you don't want to overdo it so that you enter a recession phase. This is very, very important. But you will see here that the trade deficit has also narrowed sharply last month. This is the difference between imports and exports for the company, and you will see that there was a record trade deficit caused a contraction in outputs in the first quarter. That's exports. Now the economy can always turn on a dime, but at this point in the economic cycle, consumers are still spending their hearts out, which is interesting. And that keeps the recessionary winds at bay. That is exactly right. But again, you want to make sure that there is some spending going on without, without people overdoing it, and also without people stopping to spend at all because of too expensive prices, for example. And as inflation goes down and it gets a little bit better by the month, then this is a very, very good sign for the overall economy. And consumer spending, which accounts for more than two-thirds of US economic activity, of course, increased 0.9% last month, and the strength in spending despite consumer sentiment being at its lowest level since 2011. That's interesting. So people are kind of scared, but still there's strength in spending. And goods spending increased a solid 0.8%, services 0.9%, and economists have actually forecast a lower increase, 0.7%. So people still keep on spending. And there's another thing that is very interesting here. The fact that personal income rose 0.7% with wages accounting for the bulk of the increase. So we have a tight market right now in the US. This is very, very important because a tight market actually can cause higher wages, and higher wages can also cause an increase in inflation. So you have to have a little bit of a balancing act there as well. You don't want to overdo it really. And high and middle income households still have some savings amassed, is what we are seeing here. And the Federal Reserve is looking, of course, to cut down the inflation back to its 2% target. This will take some time for sure. And it's also exacerbated by Russia's war pretty much in Ukraine and China's COVID-19 policy. So this doesn't help at all. They really affect supply chains, among other things here. And we're expecting a rather abrupt increase again in interest rates by June and July, of course. And we'll see how we're going to be continuing with that, and whether the Fed will be able to kind of tame this kind of inflationary environment without really causing a recession. And this kind of news that spending keeps increasing, even not incredibly, of course, is good news. We don't want it to be suppressed too much, and also when inflation goes down in this environment, that's even better. Okay, so kind of wanted to mention this because it relates with this company and companies like Visa and MasterCard. And the other thing, now that we're going to be taking a little bit of a closer look at the financials, you will see that American Express has a 17 PE ratio and a 9.7 price to free cash flow ratio here. And I wanted to kind of compare it to a company like Visa, for example. And when we do that, you will see that Visa has a much higher PE ratio and price to free cash flow ratio, 33 and 30. And the same goes with MasterCard. And even though I do like both of these companies, generally speaking, their financials kind of point to them being a bit expensive here, 37 and 40. So let's go back to American Express for our analysis. And this one has been down again about 15% in the last year. And overall, in the past 5 years, has been gaining, of course. And pretty much the company has been gaining throughout its foundation, really. And the outstanding shares have been going down as well. 15% the company has been buying shares back. And they have free cash flow that would take about 12.7 years to pay back all the total liability. So they are debt leveraged here. And this kind of debt leverage could be used to increase the return on equity here, which is rather high. Net income margins are not bad as well here, 17.6%. Now, you will see the company has been having some nice growth here over the years. With net income, free cash flow has had the slowest growth here. But still, everything seems to be growing rather nicely for the most part. And they actually reached even negative equity territory at some point. Okay, so the dividend yield that they're paying, 1%. So they do pay a little bit of a dividend, a very safe one at a 10% free cash flow payout yield. And if we take a look at the dividends that they have been paying through the years, they have been increasing pretty much substantially in the last quarter. But overall, they have been increasing very nicely through the years. And yeah, this seems to be a very safe dividend here. The effective one is 1.23 right now if you buy the company, the stock, pretty much today, that is. So if we take a look at the financial statements, you will see here that the company's revenue have been increasing, of course, almost doubling. And then their net income has been almost quadrupling here. Very nice to see for the company. And their balance sheet has gone through some stages, but right now it's sitting at $22 billion. And the cash flow statement, you will see the increase in the net income here, which translates to an increase in cash provided by operating activities, so sitting at 14.65 billion right now. And the company is spending quite some here in investing activities and a little bit in capital expenditures, not that much. And also over here, you will notice that they are paying back some debt, which is a good thing to see, of course, in the dividends that they are handing to stockholders. And their free cash flow has been increasing from 12.4 billion to 13.1. And the interesting thing, the cash has been going down a little bit. I'm assuming this has to do with the stock buybacks, because they have been purchasing a lot of stock, as you can see here, 9 billion in the last year, pretty much. So yeah, this definitely affected their cash. So the next thing, take a look at the stock evaluation tool, see what kind of price it makes sense to pay for this one. Now the revenue growth has been increasing nicely lately at 19%, 16%, the average is about 11. I'm going to use something like, let's just say 9, 11 and 13 here. And for the net income margins, the average is 17%. I think I'm going to go maybe let's go 17, 18 and 19. The average is, the average is 16.88. Let's actually go a little bit lower. Let's go 16 here, 18 and 20 maybe. The net income the company has been doing a couple of years, in which it was above 20 as well. And the free cash flow margin tends to be relatively high here with positive net incomes. So I'm going to go 100, 105, and 110, and the annual return of 13%. So if we hit calculate, we are seeing that the current price of the stock is rather low compared to the max price to pay here. And so this points to the company being a solid buy over here based on their financials. Now, you may have thought that I went a little bit offensive, aggressive here, and we can try to go down a bit. Let's just go 6, 7, and 8. Be much more conservative here and see what we're getting. And so if we do that, it's only our low estimates that are off of the current price, and not by much really. It's about $10 or so, and so that would be about like 5 or 6%. And so we are sitting at a point where even at a 7% revenue growth increase for the company, we are within our limits here and easily, comfortably within our medium estimates here, with a net income margin of 18% in this case, which may be a little bit too high. And I can even try going a little bit lower here, be even more conservative. So 16 here and 18. Let's go 17 here and see what we're getting out of this one. We're becoming even more conservative, and we are still in the green for our medium and high estimates. Now our low went a little bit lower, of course, but that's to be expected. And this is just a 6% revenue growth with a 14% income margin. So both of these values are fairly low here for our projections, and our medium ones are, I think, very fair, and I could see the company achieving even the high ones pretty comfortably, frankly speaking. Remember, this is an 8% revenue growth increase. You can see the revenue growth here. The company has only had a 7% in 2019, but everything else has been 19, 16, 18. So yeah, it's probably not very likely that they're gonna do just 8%, but yeah, we just try it so that we see what kind of value we're getting. And so this is why I like American Express right now. It's a company that I'm potentially looking to enter, and this one is looking fairly solid for a buy and hold pretty much throughout decades, frankly speaking. And yeah, I wanted to make a video and talk about it. Tell me what you think about American Express, and whether you prefer it over other companies like MasterCard or Visa, or maybe none at all, or maybe you prefer another one. Just let me know. Leave a comment below, and remember to like and subscribe in the channel. And also, you may want to become a Patreon and kind of examine all the stocks that you want, all your stocks. You can get unlimited access and do this kind of analysis on your own for any stock. And thank you for watching this video again. I'll see you soon, and bye bye.